In this video, I am revealing the exact step-by-step method on how to calculate your lot size and stop loss perfectly every single time. One of the biggest mistakes that beginners make is that they enter a trade with a random lot size and just guess their stop loss placement. This is actually the fastest way to blow up your trading account and lose all of your money. But what if I told you there's a simple mechanical formula that professional traders use to know exactly how much to risk and where to exit if the trade goes wrong? If you master this one concept, your trading will completely transform from gambling into a consistent and professional system. In this video, I will show you everything you need to know about proper position sizing, where to put your stop loss so you don't get stopped out early, and how to calculate your lots properly. So without further ado, let's dive right into it. First, we need to talk about the stop loss. What is a stop loss exactly? A stop loss is an automatic order placed with your broker to close your trade when the market goes against you, preventing further losses. The most common mistake beginners make is using a fixed pip stop loss for every single trade. For example, they will always set a 20 pip stop loss no matter what asset they are trading. This is actually a really bad idea because remember, different markets have different levels of volatility. If a market has high volatility and you only put a 15 or 20 pip stop loss, 9 times out of 10 it will most likely get hit and you will get stopped out early only to watch the price reverse and go in your favor anyway. So instead of guessing, you need to base your stop loss on actual price action and market volatility. The easiest and most effective way to place a stop loss is by using market structure, specifically swing highs and swing lows. Let me show you an example. Let's say you spot a valid uptrend and you decide to enter a buy position. Instead of randomly picking a pip amount, you want to place your stop loss slightly below the nearest swing low. The logic here is simple. For an uptrend to remain valid, the price must continue making higher highs and lower lows. If the price drops and breaks below that previous swing low, it means the market structure has shifted and the uptrend is now invalid. By placing your stop loss just below that level, you are staying in the trade as long as the trend is valid and getting out the exact moment the trend is proven wrong. Now that you know exactly where to place your stop loss on the chart, the next step is figuring out how much money you should actually risk if that stop loss gets hit. This brings us to account risk management. Professional traders never risk their entire account on one trade. If you want to grow a trading account consistently, you must strictly risk only 1 to 2% of your total capital per trade. Let me explain what this means. Let's say you have a $5,000 trading account. If you decide to risk 2% per trade, that means your maximum allowable loss for one single trade is exactly $100. Why is this rule so important? Because trading is all about probabilities. You will have some winning days and some losing days. If you hit a losing streak and lose 5 trades in a row at 2% risk, you have only lost 10% of your account. You still have 90% of your capital left to easily recover. But if you were risking 20% per trade, your account would be completely wiped out. So we know our stop loss placement on the chart, and we know our maximum risk amount. Now, how do we calculate the lot size so that our specific stop loss distance equals exactly our risk amount? Here is the exact formula you need to use. Lot size equals your risk amount divided by your stop loss in pips multiplied by the pip value. Let's look at a practical example to hopefully clear things up. Let's say you are trading the Euro-USD pair and your total account size is $5,000. You are following the strict 2% risk rule, meaning your maximum risk amount for this trade is $100. Next, you spotted a valid buy setup and you placed your stop loss below the nearest swing low. You measure the distance from your entry price to your stop loss and it comes out to exactly 25 pips. In Forex, the pip value for a standard lot on Euro-USD USD is exactly $10. So now we just plug these numbers into our formula. You take your $100 risk and divide it by 25 pips multiplied by the $10 pip value. 25 times 10 is 250. 100 divided by 250 equals 0.4. So for this specific trade, you need to open a buy position with a lot size of exactly 0.4 lots. By doing this, if the trade goes completely wrong and hits your 25 pip stop loss, you will lose exactly $100, keeping your account perfectly safe. Let's look at another example to see how this adapts to different market conditions. Imagine it is later in the day and the market volatility has started to pick up. You spot a valid short position, but because the market is making much larger movements, your nearest swing high for your stop loss is now 60 pips away. Because the stop loss distance is much wider, you cannot use the same lot size as before. If you used 0.4 lots again with a 60 pip stop loss, you would lose $240, which is way more than your 2% limit. So we use the formula again. Your risk amount is still $100. You divide that by 60 pips multiplied by the $10 pip value. 60 times 10 is 600. 100 divided by 600 equals 0.16. So for this volatile trade, you will use a much smaller lot size of 0.16 lots. Notice how your lot size automatically changes depending on how wide your stop loss is, but the actual dollar amount you are risking remains exactly the same at $100. This is the ultimate secret to risk management. Finally, after you have set your perfect stop loss and calculated your lot size, the last step is determining where to take profit. For your exit strategy, you always want to make sure you have a positive risk-to-reward ratio. If you are risking $100 on a trade, your potential profit needs to be much higher than your risk. A simple and effective exit strategy is to set your take-profit target at 2 times the size of your stop loss. So if your stop loss is 25 pips away, you set your take-profit at 50 pips away. This gives you a 1-to-2 risk-to-reward ratio, meaning you are risking $100 to make $200. By using this strategy, even if you only win 50% of your trades, you will still be highly profitable at the end of the month because your winning trades are always twice as big as your losing trades. If you want to maximize your profits even further, you can use what is called the two-step take-profit system. This is how it works. You enter your calculated lot size, let's say 0.4 lots. You place your take-profit at 1.5 times your stop loss. Once the price hits that first target, instead of closing the whole trade, you only close half of your position. Then you move your stop loss to break even. Now you let the remaining half of your position run completely risk-free until the trend reverses. This method ensures you lock in guaranteed profits while still capturing huge market movements. I just revealed to you the exact method on how to calculate your lot size and stop loss so you can start trading like a professional. And all I ask for in return is for you to invest 2 seconds of your time into liking the video and subscribe to the channel. It literally takes only 2 clicks, but it means so much to me. And you can also check out my other videos as well. Thank you guys for watching, and I'll see you in the next one.